and welcome to this episode of WindowCast. We're broadcasting live from the bustling trade show floor at GlassBuild America in Orlando, Florida, where the fenestration industry's best and brightest have gathered to showcase the cutting-edge products and innovations in the industry. This episode is brought to you by our series sponsors, Dow, innovating for a sustainable future in building materials, and Lansing Building Products, your partner in quality building supplies. Thank you for your partnership. I'm Laurie Cowan, editor of Window and Door magazine. Today I have the pleasure of speaking with Chris Beard, Vice President of Building Products Research at John Burns Research and Consulting. Chris is well-versed in the dynamic environment surrounding building products, helping clients and partners understand trends and inflection points within the broader building products and housing industry. In addition to the Window and Door Market Survey, the result of an exclusive partnership between Window and Door and John Burns Research and Consulting, Chris leads John Burns' monthly dealer survey as well as a quarterly survey of structural component manufacturers. Plus, he monitors public building products companies' earnings. Chris, welcome.
Thank you. Great to be here.
All right, thank you. It's great to have you back here. This is your third GlassBuild now, discussing different trends and the economy and specifically the window and door market.
It is. It's great for the third year, and the more things change, the more they stay the same, it seems like.
Indeed. Well, I would love to jump in with talking about a broader picture of the economy, including consumer confidence and the housing industry and remodeling. So could you start off by talking about where we are with consumer confidence right now?
Yeah, sure. So I think entering the year, a lot of people, not just in the fenestration industry, but in the broader economy and in the housing industry specifically, were more optimistic about how 2025 would transpire. Consumer confidence was ticking up slightly at the end of last year. We started to see some positive inflections. The Fed started lowering interest rates. There was some certainty after the election, thinking that things would gradually start to improve and start to get a turnaround. And then as we moved into the year, we certainly had, it just seemed like one announcement after another, from tariff announcements to government policy changes. Interest rates were sticky. Inflation was sticky, and just a lot of churn. And like I like to say that 2025 seems to be, the word of the year is uncertainty, and it just, we're seeing that. And we're seeing that certainly now with the government shutdown that's still ongoing for now over a month. We're not getting reports on labor market data, housing data, and so just general uncertainty. And you think back, to how you react personally, I'm no different, and I think most consumers are the same way. In times of uncertainty, you just kind of keep things close. You just say, I'm not going to make any big, bold decisions right now. I'm going to, watch my finances. There is more concern around job losses. We are certainly seeing weak labor market data. When the government was still reporting, we actually went negative in the month of June this year. And so all of these things have just kind of created a whirlwind in consumers' minds. And so uncertainty is just causing a decline in consumer confidence. Really, it's at about a 10-year low right now in consumer sentiment. And so, people are just sitting on their hands and kind of waiting for things to stabilize before moving forward.
Sure. One of the elephants in the room in this industry has been housing affordability for a while now. Can you speak to that a bit?
Yeah, I mean, the affordability, obviously the importance of housing increased significantly after COVID. On average, aggregate building products prices were up 40% over 2019 levels. Land prices increased significantly. The cost to build homes increased significantly. The price that consumers had to pay for homes, and certainly existing home values went up with that too. So house prices have increased significantly. Really, no secret. Everybody knows that. And so, the question is, will house prices come down, and then if so, how much? And what we're starting to see in the new construction market, we're seeing low single-digit decreases in home prices, but the housing cost to income ratio are still elevated. And one of the things that we do at John Burns is we rate markets by housing affordability and if it's a good time or bad time to invest. And what we're seeing is basically every market in the country is still very overpriced, especially looking at long-term historical averages. So that's playing on people's minds. Mortgage interest rates obviously still significantly higher. They've been coming down recently, but the expectation, I think, from consumers is that mortgage rates will be coming down more significantly. And so we ask, we've been doing this for 3 years now, we ask consumers, what is what we call the magic mortgage rate? The mortgage rate at which they will decide, okay, it's a good time to buy a house or transact. And they've been telling us pretty consistently it's 5.5%. And we don't anticipate 5.5% rates anytime in the near future, over the next several years actually. We look at the bond market, what the 10-year Treasury is doing, and we think mortgage interest rates are going to be above 6% for the foreseeable future, as they have been. They're not 8% anymore, or touching 8% as they were a couple of years ago, but they're still above 6. So from a consumer's perspective, that's still above where it needs to be for them to want to transact. Builders have been successfully doing rate buy downs, so they've been actually able to buy down, many of them have been able to buy down that mortgage rate to get that into the 5s, some are even in the 4s ranges now on mortgages, and that has kind of propped up the new construction market. But we did see slowness throughout 2025 for the reasons that I mentioned. Those consumers just kind of sitting on the sidelines. So I think everybody's just kind of waiting for prices to come down.
Okay. Now, in terms of household formation, what does John Burns anticipate will be coming with that?
Yeah, one of the things that we do, we have a very strong demographics team. Eric Finnegan on our team leads our demographics group and is out in public doing quite a bit of speeches and promoting this. The good thing is demographics are relatively predictable in what we call household formation years. And the way I like to word it is somebody who's 35 today is going to be 45 in 10 years and was 25 10 years ago. So that gives us some predictability. Through 2034, we're seeing a big bump in household formations in the age groups of 70 plus and then 25 to 54. And so this is really interesting, and these are household formations. So 70 plus, traditionally, and I would say pre-COVID, this is the time when you'd expect some unwinding of property and people would be moving into either in with their kids or assisted living facilities, retirement communities, and we're not seeing that. We're seeing aging in place as improvements and product innovation has allowed older homeowners to stay in their homes longer. We think that they're going to stay in their homes longer and then continue to form households. And then another big bump is age groups 25 to 54. So there's been a lot of talk of the millennials. When are the millennials finally going to form households? And we're seeing that unwind right now. And so that's really the sweet spot for housing. And we like to say that it's strong for suburban housing demand, because if you think about when you're 25 to 54, what are you doing? You're usually getting married, having children, moving in with somebody else. And we think that that's primarily going to drive single family. And then particularly like suburban housing, single-family suburban housing demand, just because the big bump in those age groups that we're seeing.
Now, new housing is tough right now with affordability, and then of course with people moving from house to house. What does the remodeling market look like for those who are looking to stay in their homes but upgrade?
There's been talk for a number of years since interest rates increased. There are a huge wave of people that refinanced when the Fed funds rate was 0, and around 20% of all outstanding mortgages, I think there's 52 million outstanding mortgages in the U.S. Around 20% of them are locked in at rates below 3%, and then 4%, et cetera. So there's people that are locked into those rates. That is. We've been saying this for a while, and we think it's going to continue to be true, is going to be a tailwind for remodeling, because if you're looking at moving and taking on a 6+% interest rate, but you have a 3% interest rate now, that's a significant change in the monthly payment. So, and then coupled with that, homeowners have a huge amount of home equity built up in their homes if they transacted before COVID. So you think about where house prices were in 2019 versus what they are today and what they were even 2 or 3 years ago, that people are sitting on almost record levels of home equity. And we think that that's going to be tapped into, and we think that will be a tailwind for remodeling. We think where we're at right now, obviously there was a lot of pull forward demand during COVID. People were stuck at home. They got stimulus money, weren't spending on other things, working from home, could see things that they maybe wanted to just do around their house. So there was significant pull forward in remodeling. Let's call it, mid-2020 through through the end of 2022 into 2023. But we think that, since 2024, we're actually kind of in a deficit. So we believe that we're in a deficit of people spending below average, below historical average on home improvement. And so, once consumer sentiment improves, once we start to see some stability in the overall macro, and people feel good about where the economy's headed, their own personal situation, we think that's going to be a pretty significant tailwind for remodeling.
Mm-hmm. Absolutely. Moving more specifically into the window and door market survey, I know the results of the most recent survey just came out. Can you start by talking about what some of the revenue and volume expectations are and results were?
Yeah, it's really interesting. I presented on the main stage yesterday, and I said this industry exudes optimism, which is a great thing. That it would be really bad if that wasn't the case. Very entrepreneurial, this industry, and that's one of the reasons I love it so much. But as we entered 2025, expectations at the end of last year, the fourth quarter of 2024, were that revenues and volumes would be up significantly. And again, thinking back to what I said earlier, consumer confidence at the end of 2024 was higher, and so people were thinking like, okay, if 2025 is finally going to be the year of the rebound that we're going to expect after a couple of years of softness. And as we move through the year, new construction especially, but also on the repair and remodeling side, it just seems like expectations in the overall market has deteriorated. And so we saw moving through the first quarter, second quarter, now the third quarter, volumes are down, revenues are down. But what I find very striking is we asked for a first look at 2026, and I think 3/4 of the manufacturers and big installers said, no, we're expecting volumes and revenue to be up next year. No surprise, like I said, this industry exudes optimism, which is great. And so we're going to be monitoring this, but the industry is expecting volume growth next year and revenue growth. What I find interesting is I think how 2025 transpired. The expectations for 26 from right now in the fourth quarter of 25 are a little bit weaker than the expectations for 2025 as they reported in the fourth quarter of 2024. So it seems like some of that optimism for next year, if you will, has tempered a little bit, but still the industry is expecting growth in shipment volumes and revenue. We think that's probably going to improve as we move through 2026. I don't think there's going to be a quick on switch, January 1st, here we go. But we do expect improvement as we move through 2026, both on new construction and repair and remodel.
Mm-hmm. Yesterday you shared that one of the segments that is really growing and carrying the industry is that of the affluent customer and those in the luxury market. Can you talk to that a bit?
Yeah, I think we're moving into a period of it was a little bit of a pause during COVID, but a bifurcation of the economy. So I've seen things like two-speed economy, and the affluent consumer is still doing okay. And then, kind of the middle and the lower end consumer is struggling. Like I said, inflation's been a little bit sticky, but the affluent consumer is not as sensitive to mortgage rates. They're cash buyers generally. They don't get as big of sticker shock. And then other things, wealth effect. Number one, the properties that they may already own, those home values are still high. They're still feeling good about those investments. Stock market has done exceptionally well this year for the most part. And so the wealth effect seems to be holding for them. And if you look at single family starts, custom home starts are still up year over year. Production homes, entry-level homes have kind of taken it on the chin in 2025, but custom home starts are up. And we've been hearing from remodelers that we talk to. I'm hearing this from the building materials dealers that I talk to every month. They say custom home demand is still pretty strong. And interestingly, in this quarter's survey that we partner with you all with, we asked what is the strongest customer type. And the strongest customer type was the luxury or move-up remodeler. The second strongest customer type was the custom home new construction. And the weakest customer type that they reported was the entry-level new construction buyer. So that's kind of played out in the data that we're seeing. And I talked to the manufacturers, and I'm hearing like wood window shipments, and composite fiberglass. They seem to be doing okay, but vinyl shipments seem to be way down this year. So that kind of speaks to the bifurcation of the customer types.
How is the workforce changing, both on the production side and also on the sales and marketing office side?
So each quarter we ask the manufacturers, are you planning to add, keep, or reduce your production workforce? And then the same for your sales and marketing resources. And interestingly, throughout 2024, pretty much nobody said they were going to cut either. A lot of talk of adding sales and marketing resources, especially. So the notion around then was the industry needs to, after really strong demand in 20, 21, 22, the industry had to relearn the sales process. Relearn how to, don't just be an order taker because demand is off the charts, but actually kind of, fight for the business and relearn the sales process. And so we saw a number of firms saying, we're going to add to our sales and marketing resources because we need to get that pipeline filled back up as the market weakened last year. And so throughout 2025, we've seen a growing share saying they're actually going to reduce sales and marketing resources. And we think the main driver, we read through the qualitative commentary that comes through, we think the main driver of that is just cost. Material costs have gone up. Material costs are actually increasing now, primarily due to tariffs, it looks like, so input costs, and so manufacturers especially are having to look at their cost structure, and they're saying, okay, we may have just a little bit too much headcount. On the production side, they're also, I think roughly a quarter of them said they're planning on reducing production workforces. Certainly you all have reported on it. We've seen plant closures this year. I think we're probably not done with those. So we're seeing capacity reductions in the industry. But what's telling to that is we also ask, what is your main focus area over the next 12 months? And by far, the main focus area right now is production automation. So improving efficiencies, doing more with less. And so I think that's how people are thinking about the overall industry. Like we're not projecting strong demand. It's a little bit tempered than what we thought it was going to be last year. And so we need to figure out our staffing plans, but then also do more with less. Be able to ramp up for growth when it arrives by just being efficient in how we make product.
Sure. What advice do you have for companies navigating this economic time?
In times of uncertainty, I would approach it just like you probably do in your own personal situation, is just watch your cost structure. Be ready for growth when it hits, plan for it, but just monitor the uncertain economic situation. I mean, we've had a lot of wild cards thrown at us this year. I'm not sure if we're done with the wild cards as we move through this year into next year. And so, I would advise, watch your debt. If you can pay that off, and that's great. And like I said, manage your cost structure accordingly, but be ready for growth when it does hit, not to the detriment of being able to gear up for growth.
Well, Chris, thank you so much for being here today. It was a pleasure, as always, to talk to you and get your insights and that of John Burns.
My pleasure. Thanks for having me. Great to see you.
Of course. And that wraps up this episode of WindowCast, live from GlassBuild America in Orlando. And once again, thank you to our series sponsors, Dow and Lansing Building Products, for sponsoring the Live at GlassBuild podcast stage. Don't forget to subscribe to NGA's YouTube channel and follow WindowCast on your favorite podcast platform for more industry insights and conversations. I'm Laurie Cowan. Until next time.